Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Imagine maxing out your credit cards to buy, I don't know, millions of gallons of milk.
Right, knowing for an absolute fact that it's all going to spoil in exactly 2 years.
Exactly. That is essentially this massive, almost invisible gamble that the world's biggest artificial intelligence companies are taking right now. I mean, we are talking about a fundamental shift in how the AI industry is being funded.
Yeah, and it's happening entirely behind closed doors. It really is a phenomenal shift. For the past few years, the public has just been totally obsessed with the AI tech race. Who has the smartest chatbot? Who can generate the best video?
Right, the fun stuff that makes the news.
Exactly. But if you look at recent financial analysis, that tech race has secretly transformed into what we call a balance sheet race. It is no longer just about who has the best engineers. It's about who can engineer the most complex financial machinery, really.
To afford the sheer computing power required to just stay in the game, right?
Right, because that power is incredibly expensive.
Well, I want to pull back the curtain on that machinery today, because our mission for this deep dive is to break down a concept called chip financing.
Which sounds dry, but it's really not.
No, it's wild. We are going to unpack this so that anyone, even if you have zero background in economics, can understand exactly how these billions of dollars are moving. And for you listening, this isn't just some abstract Wall Street concept.
Not at all. It impacts everyone.
Yeah. Whether you're trying to make sense of your tech stocks, reading the daily AI news, or honestly, just watching mortgage and interest rates in the current American economy under President Trump, understanding this hidden debt machine is going to completely change how you view the financial world.
Because the sheer scale of the borrowing happening in the AI sector right now, it's rippling out into everyday capital markets. To put it bluntly, these tech companies are borrowing so much money that they're actually affecting the price of money itself.
Okay, we constantly hear about how incredibly expensive AI is, right? Like, building these massive artificial intelligence models requires billions and billions of dollars in specialized computer chips.
Tens of billions, yeah.
Right. But I've always wondered how these tech companies actually afford them. Like, looking at the data, Blackstone is proposing a staggering $36 billion financing deal for the AI company Anthropic. $36 billion is a crazy amount of money for any single company to drop at once.
It's unheard of.
So how are they pulling that off?
Well, the surprising answer is that they aren't actually buying these chips outright. The data shows this proposed $36 billion deal is actually a follow-up to an already completed $35 billion deal led by Apollo and Blackstone.
Wait, so that's over $70 billion combined.
Yes. Together, this forms an entire AI infrastructure platform, and the ultimate goal they're funding here, supporting 20 gigawatts of computing capacity by 2028.
Okay, let's unpack this, because I hear terms like 20 gigawatts and my eyes just kind of glaze over.
Yeah.
Give me a sense of scale. What does 20 gigawatts actually look like in the real world?
Well, think about a massive nuclear power plant, like the kind with those giant cooling towers.
Sure.
A typical nuclear reactor produces about 1 gigawatt of power. That's enough to power roughly 750,000 American homes.
Wow, okay.
So 20 gigawatts is the equivalent of 20 large nuclear reactors running at full capacity, powering, 15 million homes.
That is terrifyingly massive. And instead of powering cities, all of that electricity is just going to run AI computer chips.
Exactly, just humming away in data center.
It's insane. But let's go back to the money. Because if Anthropic needs these chips, but isn't buying them directly with their own cash, what is the actual mechanism? I'm thinking about this from the perspective of, an average American trying to run a business.
Right.
It sounds a lot like leasing a delivery truck for a small business. Let's say you own a bakery and you need a specialized refrigerated truck. You don't just empty your business checking account to buy a $100,000 truck up front.
Right, that would bankrupt you on day one.
Exactly.
Yeah.
So a bank buys it,
Mm.
you pay them a monthly lease, and you get to keep your cash on hand to actually buy flour and sugar.
Mm.
Is that essentially what Anthropic is doing?
You've hit the nail on the head. You're changing the timing and the owner of the expense, but the expense itself doesn't disappear.
Right.
Traditional tech companies used to just buy their own servers. It was a straightforward purchase. But at this new scale, spending $70 billion in cash all at once is just not feasible, even for the biggest tech giants. So they lease the equipment.
But if Anthropic isn't buying these incredibly expensive AI chips themselves, who exactly owns them? Who is playing the role of the bank in my bakery analogy?
This is where we get into the mechanics of what the financial world calls a special purpose vehicle, or an SPV.
An SPV.
Yeah. Think of an SPV as a temporary, standalone mini company created for one specific, highly focused job.
You lost me a bit there. Why create a mini company? Like, why doesn't a bank just loan the money directly to Anthropic?
Well, it comes down to isolating the risk. If you loan $70 billion directly to Anthropic, and Anthropic's new AI model is a total flop and the company goes bankrupt.
You lose your money.
Exactly, you lose it all. But if you create an SPV, that SPV's only job is to own the computer chips and rent them out. The SPV goes out into the private credit markets. These are massive pools of money from insurance companies, pension funds, wealthy investors, and it borrows the billions of dollars.
Ah, I see. So this mini company, the SPV,
Right.
is the entity actually taking on the massive debt.
Yes, exactly. The SPV uses that borrowed money to buy Google TPUs, which are highly specialized AI chips, along with a massive amount of Broadcom networking gear.
Okay, so the SPV buys the hardware.
Right. Then the SPV turns around and rents all of that equipment to Anthropic. Anthropic saves its upfront cash, paying a long-term lease instead. Meanwhile, the pension funds and insurance companies that lent the money to the SPV get a high-yield asset tied directly to the booming AI industry.
Honestly, it sounds like a perfect setup on paper. Anthropic gets its computing power without going broke on day one, and Wall Street gets a shiny new investment that pays them a steady return.
On paper, it's brilliant.
But there has to be a catch. We are talking about computer chips here. Technology moves incredibly fast. What happens if the chips the SPV just spent billions on become totally obsolete?
And you've just identified the biggest structural risk in this entire setup. In finance, this is called technical depreciation.
Technical depreciation.
Right. When Wall Street finances an airplane or a commercial skyscraper, they know the asset will hold physical value for decades. A Boeing jet can fly passengers for 30 years.
Yeah, the building's a building.
But AI chips are entirely different. They lose their economic value rapidly when faster, more power-efficient models are released. If a new chip comes out next year that does twice the math, using half the electricity, the old chips become economically useless,
Even if they still technically work.
even if they work perfectly.
Here's where it gets really interesting. Going back to everyday examples, it's like leasing the newest smartphone. When you lease a phone, the bank financing that lease is terrified. The phone will be completely worthless in 2 years when the new model drops with a better camera.
That's a great way to look at it.
So how do these massive private credit funds protect themselves from being stuck with billions of dollars in outdated, worthless chips?
Well, to make the deal happen, the manufacturer of the networking equipment, in our AI case, Broadcom, steps in. Recent data shows Broadcom provides what's called residual value support for a specific portion of the debt.
Whoa, stop right there. Residual value support, break that down for me like I'm 5.
Sure, it is essentially a buyback guarantee. Broadcom promises the lenders that if the resale value of the networking gear and chips crashes in the future, Broadcom will absorb some of that loss by guaranteeing a minimum value for the equipment.
Oh, wow. So Broadcom is acting as both the supplier of the gear and the safety net for the financial structure.
Exactly. And by offering that guarantee, they make the safest slice of the debt, known as the senior bonds, look incredibly secure to conservative investors.
Okay, you threw out the words bonds and senior bonds. I want to make sure we don't lose anyone here. A bond is basically just an IOU, right?
Yeah, pretty much.
You'll lend a company money, and they give you a bond promising to pay you back with interest. But what makes a bond senior?
Think of it like a line outside a very exclusive nightclub. Or, well, in this case, a bankruptcy court.
Fun nightclub.
Right. If the SPV fails and can't pay its debts, the senior bondholders are at the very front of the line. They get paid back first from whatever cash or assets are left over. Because they are at the front of the line, their investment is safer. And because it's safer, they accept a lower interest rate or yield. Broadcom's guarantee heavily protects these folks at the front of the line.
But wait, in any loan structure of this size, somebody has to be at the back of the line? Broadcom isn't guaranteeing everything, are they? Like, what about the junior lenders taking on the riskier parts of this debt?
What's fascinating here is your suspicion is spot on. Broadcom's safety net is strictly limited to the front of the line.
Oh boy.
According to recent market analysis, there is a whole other layer of this debt, the junior bonds. These investors are at the back of the line. If things go south, they get paid last, if at all.
That sounds incredibly risky.
It is. Because they take on all that massive risk, they demand a much higher return. Currently, these junior bonds yield around 8.5%.
8.5% is a huge return in the bond market. But if Anthropic fails to pay its rent, or if the chip's value plummets and Broadcom's guarantee hits its limit, those junior bondholders just take the loss directly to the chin.
Yep. They are entirely dependent on Anthropic's future cash flow. They're basically hoping the music never stops.
Right.
They are betting that corporate demand for AI will grow so fast that Anthropic will always have the cash to pay the lease on those chips.
This brings up something I noticed in the research that feels a bit precarious. We have this perfectly designed financial safety net for the VIP investors at the front of the line, but the whole system seems incredibly interconnected. The analysis actually described it as a form of circular finance.
The circular nature of this ecosystem is one of its most defining and potentially dangerous features.
Walk me through it.
Let's trace the circle. Google is a major investor in Anthropic.
Okay.
Google also supplies the TPU chips. Broadcom supplies the networking gear and backs the debt for the SPV. Private credit firms fund the SPV's purchase. And Anthropic pays the rent to the SPV to run its AI services.
It's literally a circle. Why are they doing this complex dance? Why don't these massive tech giants just act independently? Google has billions in cash. Why do they need this convoluted financial cartel?
Because the capital required is simply too vast for any single balance sheet to absorb.
Even Google's.
Even a titan like Google doesn't want to carry $70 billion of rapidly depreciating computer chips on its main public balance sheet. It would ruin their profit margins and terrify their shareholders.
Ah, so they spread the burden.
They force everyone to hold hands and support each other's transactions.
But if everyone is holding hands in a circle, what happens if someone trips? Like, if corporate demand for AI slows down, doesn't this entire ecosystem crash together?
It is a textbook example of concentration risk.
Right.
On paper, you have a diversified deal involving Google, Broadcom, Anthropic, Blackstone, and Apollo. A pension fund looking at this might think, great, my risk is spread out across 5 major companies.
But underneath?
Underneath, they are all exposed to the exact same single risk factor, the assumption of endless exponential AI demand.
So if a bunch of Fortune 500 companies decide next year that, hey, these AI chatbots aren't actually improving our productivity, they cancel their subscriptions.
Exactly. Anthropic loses revenue and can't pay the lease. The SPV defaults on the debt.
The junior bondholders lose their shirts.
And Broadcom is suddenly on the hook for billions in residual value guarantees. The dominoes are all lined up in a single row.
It's terrifying.
And the risk isn't just financial or software-based. The risk is deeply tied to the physical world. We aren't just talking about digital code moving on a screen. Having all these advanced chips is totally useless without the physical infrastructure to plug them into.
Right, because you can't just plug a 20-gigawatt AI supercomputer into a standard wall outlet. We are talking about industrial power connections, massive cooling systems so the chips don't literally melt, and giant data centers taking up acres of land.
Exactly.
In fact, I saw a note in the financial reports that Google's backing actually includes a 2.4 gigawatt power project tied to $15 billion in debt.
And this is a crucial point that many retail investors completely overlook. The true bottleneck in the AI revolution might not be money, and it might not even be chip manufacturing.
It's electricity.
It is electricity. You can borrow $36 billion and buy all the chips in the world, but if a data center's construction is delayed because they can't get a permit for a new electrical substation from the local town council,
those leased chips just sit in cardboard boxes.
I sit in boxes.
And while they sit in those boxes, the clock is ticking on 2 fronts. You have the technological clock ticking, meaning the chips are getting closer to being obsolete every single day.
Yeah.
And you have the financial clock ticking, because that SPV is racking up 8.5% interest on billions of dollars in debt.
But the chips are generating exactly zero revenue. If the physical power grid cannot keep up with the delivery of the chips, the financial structure starts to buckle under its own weight.
Okay, we've established how massive and risky these financial loops are. But let's bring this back to the listener.
Sure.
If someone is listening to this on their commute, they might be thinking, I don't own Anthropic stock, I don't run an AI company, and I don't invest in private credit. Why should I care about Blackstone's SPV?
Right. Why does it matter?
Yeah. So what does this all mean? What is the real-world impact for the average American looking at their 401k or trying to buy a house?
Because this massive borrowing impacts global capital markets. The global bond market, where debt is bought and sold, is essentially a giant finite pool of money.
Okay.
When tech companies and these AI SPVs issue tens of billions of dollars in debt, They act like giant vacuums in that market.
So they're sucking up all the available capital that would otherwise go somewhere else.
Precisely. And when they do that, they have to compete with everyone else who wants to borrow money, including the United States government, which issues treasury bonds, and regular corporations issuing corporate bonds.
I see.
To convince an investor to put their money into a risky AI SPV instead of a safe government bond, the SPV has to offer a really high yield, like that 8.5% we talked about.
Oh, I see where this is going. If the private credit market is offering an 8.5% return, the government can't just offer a 1% return on their bonds because nobody would buy them.
Exactly. The government has to raise their rates to attract investors.
And that upward pressure on yields keeps long-term interest rates high across the entire economy. Mortgage rates are directly tied to those government bond yields.
Yes.
If you are an American watching your mortgage rates, hoping they will drop so you can afford a house, you need to realize that these AI companies are acting like giant vacuums in the debt market. They are effectively competing against you for capital. They are affecting the price of money for everyone else.
Exactly. Especially in the current economic landscape under President Trump, navigating inflation and interest rates is a daily reality for the middle class. If we connect this to the bigger picture, AI is no longer just inflating tech stock prices.
Right.
It is reshaping the private credit market and public bond yields. The sheer volume of capital required to build this AI infrastructure is shifting the center of gravity in global finance.
That is wild to think about, that an AI company trying to lease computer chips is subtly keeping my mortgage rate high.
It's all connected.
And the pressure on these AI companies to keep this machine running is mounting. Looking at the data, Anthropic is actively preparing for an IPO, an initial public offering, where they finally sell shares of the company to the general public on the stock market.
And the numbers being reported around this potential IPO are just staggering. We are looking at reports of $65 billion raised in private funds, a jaw-dropping $965 billion valuation, and $47 billion in annualized revenue.
Wait, nearly a $1 trillion valuation for a company that is essentially leasing all of its core equipment.
Yeah.
When you look at the hidden balance sheet raise we've been discussing, it becomes incredibly clear why they're rushing to the public markets to sell stock to everyday retail investors.
Because an IPO is traditionally viewed as a way for early investors to cash out, right? Celebrate a successful business. But in this scenario, an IPO is about survival. They need the public's money to feed the debt machine. When a company goes public, retail investors often just look at the top-line revenue growth. They see that massive $47 billion revenue figure, and they get dollar signs in their eyes. But what this deep dive reveals is that you cannot just look at revenue.
Because a huge chunk of the money they raise from everyday Americans in that IPO isn't going toward inventing some magical new AI feature. It is desperately needed just to service these massive lease obligations.
Exactly.
They have to pay the rent on the delivery truck or the whole bakery shuts down.
And many of these cutting-edge AI models operate at a huge loss while they scale, so those fixed lease obligations become a heavy anchor.
It makes total sense.
If you, the listener, are considering investing in an AI IPO in the future, your analysis has to go much deeper than a standard tech stock. You shouldn't just look at revenue growth. You have to look at their fixed computing lease obligations and actual cash flow.
You have to ask how much of this company's future cash flow is already promised to Wall Street private credit funds just to keep the lights on.
Exactly.
It totally flips the script on how we look at tech companies. We are so used to thinking of software companies as these lean, agile businesses. You know, a couple guys in a garage writing code with virtually zero physical costs.
Those days are over.
The AI era has turned them into heavy industry. They are borrowing money like an airline or an oil refinery, but dealing with assets that expire like a carton of milk.
It is a highly dangerous combination of massive leverage, extremely fast appreciation, and a heavy, unavoidable reliance on the physical world.
Well, we've covered a ton of ground today. From the $36 billion Blackstone proposal to the way SPVs isolate risk to Broadcom's residual value safety net, and most importantly, the very real ways this AI debt vacuum could be keeping your mortgage rates high right now.
It's incredibly complex.
It really is incredible how these invisible financial structures shape our daily economic reality.
This raises an important question, one we haven't fully explored today, but something you should absolutely think about as you watch the markets this week.
What's that?
Well, we noted that the real bottleneck to the AI revolution isn't necessarily the money or even the chips themselves. The ultimate constraint is physical electricity and the construction of data centers.
Right.
So if power is the true gatekeeper of artificial intelligence, will the most valuable tech companies of the next decade actually be the old school utility and power grid companies that hold the keys to the electricity?
Oh, wow. That is a fascinating thought to leave on. The future of cutting-edge AI might just be owned by your local power company. Thank you for joining us on this deep dive into the hidden balance sheet race of artificial intelligence. Don't forget to subscribe and hit that like button.